It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome. It's the Jill on Money Show. It's the first weekend in June, and we are so happy that you are joining us. We love to hear from you. That is the number one takeaway from the opening of this show. We love to hear from you. And the way you can get in touch with us to help you make better financial decisions is to go to our website, jillonmoney.com. Now, top right corner, wherever you are on the site, there's always a top right corner, and there is a Contact Us button. And that button will actually magically create a form. You get the form, you write your email, and we are happy to receive that email. We're going to do some emails today. But at the end of the form, it says, do you want to come on the air live with us? That's just the best. It's not that I am, mean to shy people. It's just that we always have follow-up questions. We want to know other things that are going on. And by having you on the air with us, we can do that. So don't be shy. We can change your name. We can really try to anonymize you, I promise. While you're on the website, don't forget to sign up for the free weekly newsletter. It comes out every Friday. It is the perfect way to get ready for your weekend show with us. Also, we've got other content that lives there. Some of it is free. Some of it costs some money. Check it out. Just go to jillonmoney.com. Today, we're starting with Danielle, who's on the line from Seattle.
A few years ago, an uncle died, and he left me 2 life insurance plans, one with a 3.5% interest rate and one with a 4.5% interest rate. And I've mostly left that money alone, and as of today, there's approximately 37 in the 4.5 and 43 in the 3.5. My question today is, should I continue to leave these current plans, or leave this money in the current plans, which is just managed by State Farm, and it's not it is taxed, but there are no other fees? Or would they work harder for me elsewhere? Especially considering my partner does not have a retirement plan as part of his work benefits.
Okay. Well, let's think about this. So, Danielle, how old are you?
I'm 38. My partner is 36.
Do you guys both work?
We both work full time.
And you live together?
We do. We live together.
Okay. But not married?
We are married.
I like that you say partner. See, you straight people are freaking out us gay people, because we used to say partner because we were like, we can't get married. But then you say partner, and I think you're not married. So I'm all confused, and I'm just telling you that I'm an old lesbian, and this is what flummoxes me. So you're married, which is why you live together.
I mean, it's one of the benefits, right?
I mean, it's or not. I get it. How much do you guys earn together?
Yeah, so this year our household income is about 190.
Okay, that's great.
Pre-tax.
Okay, great. And so you're putting money away into a retirement account, right?
That's right. My employer offers a retirement account. I'm maxing that out, and we're both contributing to our Roth IRAs. The past 2 years, both of us have maxed out our Roth IRAs, and we've budgeted to do that this year as well.
That's amazing. That's great. Do you guys have kids yet?
We have one 6-year-old kid.
Okay. And are you planning to or trying to put money away for the 6-year-old's future education?
Yes, I'm so proud to say that we just opened a 529 plan. I got to check that off my big girl list. And we have $5,000 in that and have budgeted for $500 each month.
That's great. How about a home? Do you rent or do you own?
We own a home. Our mortgage has a 4.5% interest rate, and we have about $200,000 left on the loan.
Do you like it? You want to stick around?
We're going to stick around. Housing is a little bit crazy, especially in our area.
How much is the place worth?
The last time I looked on Zillow, I think it's about $800,000.
Okay. Any other debt besides that mortgage at 4.5%?
No other debt than the mortgage.
Okay.
We do need to think about getting a new car in the next 2 to 5 years, though.
Okay. And what's the amount that you have saved in retirement already?
Yeah, so I have about 180 in my 401k, and my husband has a 403b from a previous employer, and that's about 20,000.
And the 2 IRAs?
Oh, shoot. I'm going to guess we maxed it out. So that was 6 and 6.5 for the past 2 years.
All right.
Like 24.
Okay, great. And the 180 that you have in your retirement, is that a pre-tax or is it a Roth?
It's a pre-tax.
Okay, got it. How's the cash flow with maxing out your retirement account, the 2 IRAs and the 529?
We have a little bit of wiggle room. So our average, monthly expenditure is about 7,000, and so we do have a little bit left over. We do live in an older home though that frequently requires fixes or updates, and so we do have an emergency cash fund also, about 40,000.
Oh, that's great.
Yeah. However, for example, our septic system failed a couple of years ago and we had to replace that, and that was very spendy.
Yeah. PU also. Not fun. So when you received this inheritance from your uncle, was this unexpected for you?
It was, yeah. My uncle was a policeman and a volunteer firefighter, and he loved helping people. He had no kids and was not married, and so I'm very, very grateful that he thought of me and left this to me.
That's so sweet. So it's held. So these are 2 insurance policies, and now because you're the beneficiary, it's just held in this interest-bearing account. Is that correct?
That's my understanding.
Okay.
Yes.
And if you were to take the money out, there's no penalty for that because you are the beneficiary. So you could potentially say, I want this money, right?
That's correct. The only thing that people have warned me about is once the money comes out, it can't go back in.
Yes, I get that. That's not a problem. So I'm of 2 minds right now. You mentioned the new car in 2 to 5 years. So is it 2 to 5 seems like a big wide swath? Do we think really more like 2 or more like 5? I'm just trying to gauge, because in some respects, I could just leave some chunk of money. We could leave the 4.5% money in there right now, or the 3.5% money, and just say, all right, this is earmarked for the car. Or conversely, I could take some of the money out. Maybe what I would say is take the money out of the 3.5% because your kid's so young, and we could just put a chunk of money, 36 grand, into the 529 account, so you can not do the 500 a month. Just use that to put money in there. I mean, I don't know so what's the car situation?
Yeah, it's probably closer to 2 years. We do have a few other investments such as CDs, which are on a ladder, and so those will come up, and we could potentially access those.
Oh, tell me about that. You left that out. What do we got in the CD ladder?
Yeah, so we have about 20,000 in a CD ladder, and we did two different, I believe, 5-year ladders, and so they're kind of staggered throughout the next 5 years.
And it's like 5%-ish? Is that what we're looking at right now?
Yeah, it ranges from 4.8 to 5.4.
Okay, we're going to get back to Danielle in just a moment. During the break, go to JillOnMoney.com, that's our website, and bookmark it. I know you're going to want to return to that website whenever you have a question, and we'll always be there for you. You're listening to the Jill on Money Show, and we'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. This is the program that tries to help you make big decisions in your life. And, I know it's called Jill on Money, and so you think it's just financial decisions. But almost every big decision in your life has some sort of financial implication. And we want you to feel like you're not alone. So if you're doing it yourself, or even if you have an advisor and you just want another set of eyes and ears on a particular situation or big decision that you're facing, get in touch with us. Just go to JillOnMoney.com and click the Contact Us button. We'll get your note. And if you want to come on the air, just check the box and Mark will do everything else. Now, while you're on the website, especially if you're making a big decision, check out my book. It's called The Great Money Reset. It's out in paperback. This is a book that came from you guys. You were making all these big decisions amid the pandemic. I listened to you and I thought, wait, I know what I'm saying to all these people. I've just got to give them the right framework that they can apply in a lot of different situations. And that's what the book is about. The Great Money Reset. It's a way to take some bold steps in your life without losing your financial shirt. And no one wants to do that. Now, while you're on the website, if you want to check out some of the free content, we've got a blog, we've got other programs, we have videos. And in the video section, it's not just my television appearances. You should also check out our YouTube show. It's called Jill on Money, powered by The Compound. The Compound are friends of mine who have another podcast and a great YouTube show, and you should check them out as well, especially if you want to go a little deeper into your investing habit. But The Compound has been a wonderful home for us to really start to experiment with different videos, short form, longer form, talking to people like you, maybe having some guests. So we're playing with it, and I think it's really cool. So check it out. You'll find it on the website. Right now, let's get back to Danielle from Seattle and talk about how she's going to handle this inheritance. So I think, first of all, you're in really good shape and you're doing a fantastic job, right? You know, I know you live in a high cost of living area, but it sounds like you bought your house right. Meaning, you know, you bought it at the right time. It has appreciated. You've got an interest rate that's affordable. You're living a great life. Specifically about these two investments, look, I am loath to just blow out of a 4.5% guarantee, but I would like to have a little supercharging of your 529 plan. I know that 3.5% feels like a nice guarantee as an interest rate, but obviously that interest rate is going to go down as interest rates go down in the future. And I kind of like the idea of getting some of this money out and into the 529 so that you can start accumulating some money, you know, over the next 12 years before the 6-year-old goes to college. Do you think you'll have another kid, or is this it?
This is it for us.
This is it? Okay. So I like the idea of probably leaving the 4.5% for now, which is fine. And, you know, either potentially using that and or the CD ladder and make this like the car account, because, you know, a couple of years, who knows, right? That'll be fine. But I wouldn't mind having you guys each put the money into the 529 that'll take you to the annual exclusion amount, which is $18,000. Have you done $500 a month so far this year?
We just started in March.
Okay.
No, I'm sorry, April.
Okay. So that's fine. You could basically say like, all right, we put this 500 in, but now you can put in, you know, 17,000 each into the account, right? Pop it in there and get it going. And now there's no tax due on it. And now you're like fully checking something off your list, which is we are kind of supercharging our 529 account. And I think that would be what I would do. And then, you know, the only other thing I would say is that 3.5% is fine, but you could literally take all the money out of the 3.5% from your uncle, right? Take everything out, put your chunk into your 529 that gets you to the annual exclusion amount, and take whatever is left over and just buy another CD for some, you know, for 4%, because you'll do better with a CD right now than you will with that guaranteed interest rate. I mean, I don't know how big a car, fancy car you're going to get, but you're going to need some money for a car. We know that, right?
Right. They don't come free.
No, sadly, no. So either in a high yield savings account, or you can just add some, whatever's left, you can add it to your CD ladder and you're done. And that's great. And then I think you're really on your way. And the 4.5% you can keep for as, you know, I think that probably it's going to come down to a little bit, but you know you're going to need the money. So, I mean, I don't know. How much money do you think you're going to spend on a car?
We would love to keep it below 20,000.
No way.
Yes, way. We are, we're frugal folks over here.
Is that possible?
We typically buy used.
Yeah, but even that.
It's our goal, right? You never know.
All right, I'm going to say 30. But... yeah, I'm sort of feeling like that's not going to happen, but okay, fine. So, and what you can do also, by the way, is that like this year will fund your 529 account, okay? Now, next year, so we're talking 2025, you know what you can do? You can say, all right, well, let me see which CD has come due in a year, where are interest rates, and what's better to do? Take the money out of my uncle's policy that's earning 4.5 or 4, like you'll see what it's earning less. Use that to do the exact same thing next year for the 529. Because I think if you get, honestly, if you get like 60 grand in there in the next couple of years, that should be pretty good. Is this kid going to go to public or private university, or do we not know yet?
We have no idea. She's in kindergarten. So.
She's brilliant. Stop it. Don't insult my little listener. All right. But I mean, if you got 60 grand in there, wouldn't you feel like a lot less pressure about education?
I think we would, yes. Our only concern is that my husband does not have a formal retirement plan through his business. And we know that you can get loans for being a student, but you can't get loans for retirement.
You sound like you're quoting me back to myself. I hate when you do that. Yeah, I don't know. Like you're putting money in your Roths and you're maxing out and you guys are young. So I don't know. I feel okay about it.
Okay.
I would rather spend the next couple of years just getting that money funded, and we'll deal with your retirement. By the way, if everything is going great and he doesn't have a retirement account, then eventually what you guys do is that, like, if you keep putting money into Roths, and if you can't do that, you can do backdoor Roths, and if you can't do that, you put money in a brokerage account, and you'll be done.
Okay, so like anything, cash flow wise, that's extra, we should put in a brokerage account.
I think so. I do think so. You're managing this beautifully, and what a nice uncle you had. And I think that it's kind of cool if like money from, listen, I'm usually not very nostalgic about these things, but if he really wanted to help people, he helps you and he helps your kid at the same time. It's kind of great. It really is.
I think that's a lovely legacy for him.
Yes. Me too. Do you guys have your estate documents done?
I knew you were going to ask that. So we do have an appointment set up with a legal office to do that.
All right. Yeah, I know I'm a nudge. I'm a total nudge. I know.
I appreciate that. I work in the medical field and we want people to have those things.
Absolutely. And do you have life insurance?
We do. My employer offers life insurance through their benefit package. And so we each have $250,000 for $4 a month.
Oh, that's good. But I don't know if that's enough. So let me keep spending your uncle's money. Okay. You probably need, do you make more than your husband?
I do.
What's your income right now?
About 120.
I think you need more life insurance, because if you died, God forbid, I know, we would lose that 120, but we'd also lose that engine of retirement growth of, you know what I mean? So I think you probably need, like, and you're young and you're healthy. So I'd get like 750 grand, or I would get $1 million of 20-year level term life insurance. And you can get that anywhere online. You can go to our sponsors, Policy Genius, or, but I think that it makes sense for you to have that protection, because you are sort of the engine of growth for the family. Without your income, there's a real problem. So let's make sure we insure that problem.
All right. I'll look into that.
Look into that. All right. I don't know. I feel like you're just yesing me. You'll look into it. You should do it.
I'm not that type of person. I can call you back in a few months.
All right. You let me know. If you have some sort of windfall and you need our help, just give a holler. Go to JillOnMoney.com and click the Contact Us button.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money, and this is the program that attempts to take the mystery out of your financial life, whatever point in your life where you find yourself. And we meet you where you are. And it doesn't mean that you have to be looking at retirement to talk about retirement. You could be in your 30s and worried about that. Maybe you are actually in your 50s and you're still working and you really like working, but you want to know how you're going to take care of your adult children. Maybe it's your aging parents. Maybe it's just a more generalized question about something going on in the world or a fear about Social Security. By the way, I have a great idea if you're really thinking about Social Security, because we have a service called Jill on Money Live, and that actually provides you with access to quarterly live webinars and a lot of cool bonus video content. And our next Jill on Money Live is focusing on Social Security, but you have to become a member. So it'll cost you $35 to get that webinar as well as 3 more after that. But you should check it out. It's a lot of fun. Okay, right now, let's talk to Eric, who's on the line from Philadelphia.
Hi, Jill and Mark. Thanks for taking my call.
Of course. What's going on? How can we help you out?
Well, I've been saving all my life. I'm currently 61 and a half. My wife is 58. We're looking to retire in a little over 4 years, and we're going to see if I'm in a good position or not currently.
All right. In other words, if I say it's not good, will you retire in more like 7 years? Or it's no way, Jill, we're retiring in 4 years?
It's 4 or bust.
Okay, I got it. So that is what I will try to make happen at the very least. Okay, so are you guys both working full time?
We're both full time, yes.
Okay, how much do you guys earn together?
About 190.
Okay, that's great. And do you both contribute to retirement funds?
My wife is in a public school, so she will get a pension, and she does have a savings account through that. But I do have a 401k with my employer.
Okay, so she has a 403B, you have a 401k, and she has a pension. I'm already liking my 4-year game plan. How much money's in your 401k right now?
$835,000.
Wow. Is it all pre-tax?
It's $50,000 Roth.
Okay, gotcha. And for your wife's 403B, how much is in there?
Currently $35,000.
Okay. And tell us about her delicious pension. I want all the details.
Well, she started late because we decided when we had children that she'd be a stay-home mom. So she's been working in the school district roughly 15 years. She'll have credit for when she retires. So it looks like between $25,000 to $30,000 a year.
Okay, that's good though. So the pension will kick in and she'll be, let's call it 62. Tell us about what your Social Security is looking like. So I'm looking for your Social Security at age 67, your full retirement age. Do you know that number?
It was 4,200, I believe.
That's you.
My wife, again, she has minimal years and she'll have maybe 15, 20 years of a full-time basis. So the last time we checked, it was going to be like maybe 11 or 12,000 a year.
So half of your benefit will be more than hers.
Yes.
Right. Okay. All right. I got it. How much do you guys spend right now? I mean, what's your need in terms of, you know, when you look forward?
Say 6,500 to 7,000, but I like a little bit higher in retirement because we haven't really traveled much, so we like to maybe go to 8,000 so you can travel more. Okay,
let's look at that 8,000 number. Tell us about the house that you own, because I bet you own a house.
Yes, it's paid off, roughly worth about 500,000.
There's no plans to go elsewhere?
Currently none.
Okay, so paid off house, expenses of $8,000. What's going on with the kitty thing?
Well, one got married last August and one gets married this Friday.
Oh, this Friday?
This Friday.
Congratulations. Mazel tov. How nice is that? Okay, so they're launched. That's good. Beyond the money that you have saved in your retirement accounts, do you have other either IRAs or brokerage account, anything else that's sloshing around on your balance sheet?
Quite a few things going on here. I-bonds, roughly 24 between us, 12 each.
Okay.
I have some ETFs, roughly $30,000. A company stock, roughly $16,000. You're going to die when I tell you this. Annuity of $300,000.
Whoa. Hello. Wow. Okay. Whose is that? Yours or your wife's?
Mine.
$300,000. Is that annuity? The money, was this from an old retirement account where you
yes,
put?
It was.
Okay. That's what I want to know. Okay. So the money that went in there has not yet been taxed is the most important question to ask about that. When did you buy this annuity?
2 years ago.
2 years ago. So it has what we call a fat surrender fee. Like if you wanted to get out of it, you can't. I mean, you could, but it's too expensive. So
25% this year.
we're not going to do that. But that's a good chunk of money. So that's awesome. Okay. So you have it. It's not like I'd want you to have an annuity, but you have it. Who cares? It's a good chunk of money. What else do we need to know about you and your wife and any future obligations? Do you have parents who are still alive that you need to help out?
My mom's still alive, but that's she has enough money to cover her expenses. The children are fine. We don't have any debt besides a car payment, so we're fine.
Okay, that's great. Right now, when you look at the monthly, your cash flow month to month, you put the money into your retirement account. Your wife puts money into her retirement account. Is there money left over every month?
Yeah, at least $1,000.
So where's that going? Into the ETFs?
Well, I forgot to mention, I do have $21,000 in a high yield savings account.
Oh, that's good.
Go into a savings account currently to boost that up for, just because.
Did that get depleted from weddings?
Most definitely.
How much did this is just my very nosy Jill self. How much did you spend on weddings?
$50K total between them.
My stomach hurts when I hear that. But you know what? I'm sure they were great. You know, my father said to me when I was getting married, he's like, well, you can have this, like he drew a sheet of paper and he put a line down the middle. On one side, he put a dollar amount, and on the other side, he drew a cake. He said, which one do you think is going to be more valuable to you over time? Oh, well, young, you make dopey choices. You take a little cake, you take a little cash. That's what I did. We'll get back to Eric in just a minute. If you've got a question, go to JillOnMoney.com. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, and we are here answering your questions. And sometimes those questions are long-range questions, really deep into the future. Some of them are immediate. If you have something going on, you need some help, you want an extra set of ears and eyes on your situation, just give us a holler. Go to JillOnMoney.com, click the Contact Us button, and write us a note. And if you want to join us on the air, just check that box. And Mark, who is the best producer in the whole wide world, he will take care of everything else. While you're on the website, check out all the content that lives there. I mean, if you can't get enough of us on the weekends, we have 2 podcasts. That's a lot of shows there. We've got videos, the YouTube show. We have so much, and we really do rely on you to tell us if you want something different or something more. Just let us know. We always try to make it about you guys. It's not about us. So the one thing I am waiting for, I'll tell you the truth, is that Mark owes me his bio and his photo, and he has yet to give it to me. And I promise that I will get that. I'm going to hock him about this. I really want you guys to know he is such an important part of this program. We are a team, and he makes it all possible. So Mark, time to get me that stuff. I've given you a lot of leeway. I know he hates being out there in the front. This is what makes a great producer. They're fastidious, they're amazing, but they don't want to be center stage. But slowly but surely, I've had him crawl out of his shell, which I totally love. Okay, now let's get back to Eric from Philadelphia. All right, so Eric, I think it sounds like you guys are in very good shape. So here's how I would think about the next bunch of years. Right now, you're putting money into your 401k. Is your wife actively putting money into her 403b?
It's automatically taken out, yes.
And is that at an insurance company or an investment company? Like, I'm just trying to figure out where's that 35 grand held?
From understanding, the state holds it.
Oh, okay. So, okay, I got it. The $1,000 a month, you're you're replenishing your savings, but over the next 4 years, once you have some amount of savings that you feel like is reasonable, like, it would be good if you had 50 grand in there. That would be awesome. So I think you'll get there in the next couple of years. Everything looks fantastic because what'll happen is, you know what? You get 4 years from now, your wife will retire, even though she'll be young. Will she have health insurance through the public school system?
Not, they'll give her some money towards a policy.
Okay.
It won't be the insurance that we currently have.
So you'll have Medicare. You'll have to pay an elevated amount for some health care, for some health insurance for her, but it's time limited. It's a few years. And you're going to go spend your $8,000 a month. So when you first begin that period in 4 years, what I would suggest is, you're going to drop down in tax bracket, right? Because remember, in 4 years, the only source of income you'll have is her pension, right? 25 or 30 grand a year. So what I would suggest is you start to pull money out of your pre-tax retirement account or accounts, but yours I'm talking about specifically, and you use that money to augment the pension to allow you to spend your $8,000 a month. And it should work beautifully because you know what's going to happen for you? I mean, if this all works out, who knows where tax rates are going, but let's just pretend it's today and you're 65 years old, right? What happens is you can take money out of your retirement account and stay in the 12% tax bracket. That is 10 full percentage points lower than where you are right now.
Right.
That's huge. So what I would be thinking about is from 65, 66, 67, right? That you pull money out of your retirement account, pay the tax that's due, you get your $8,000 a month. Because, but whatever you pay after tax, you'll have it. You'll have your pensions. You'll have some other money. Boom. Great. Now, all of a sudden, it's your full retirement age. Now you can take less money out of your 401k because you have your Social Security plus your wife's pension. Great. And if she's going to then take, half of yours, the numbers just get better and better. But I think if you say to me, retirement 4 years, are we on track? Absolutely. The couple of changes that I would think about would be beefing up the savings. You're doing that anyway. And making sure that the money you pull from your retirement account, you're trying to get more money out of that pre-tax environment and pay the tax that's due. The annuity, I feel like you're stuck with this for a while. I think we could revisit the annuity in 5 or 6 or 7 years. It might be worth it at that time to stop taking money out of your traditional 401k and to instead annuitize your IRA annuity. But we'd have to see. But I think you got plenty of money for your $8,000 a month and you're in very solid shape. Do you feel good about this?
That's the way I thought about it. I did feel confident, but I just want to hear it from someone who knows more than I know.
Well, I don't know if I know more than you do, but I know something about this. And I think you're in good shape. Do you guys have your estate documents done?
Most definitely, yes, we do.
Yes. Anything else from your point of view, Eric, that we should be talking about for you guys?
No, I'm good on my end. I appreciate all the feedback. It was very helpful.
You guys are in really good shape. So almost congratulations. And hey, mazel tov on the wedding. So have a great time. If you've got a financial question, it's so easy. Just go to JillOnMoney.com and click the Contact Us button. The Jill on Money Show. We'll be right back. You're back. It's Jill on Money, and we are here answering your questions. And before we finish up the hour, let's take this one from Roland. who writes, I will be turning 70 in September. I am retired and single. I have no mortgage and very little credit card debt. I have a rollover IRA at Vanguard. As of today, the amount in the account is at $123,700. I'm afraid that the longer I wait to convert it to a Roth, the more expensive the conversion will be. I'm on a fixed income, and I easily live on $2,000 a month, and I can even contribute to my Vanguard Roth every month. I want to know your thoughts on how much I should convert this year and next. I would love to have the full amount converted as soon as possible. What do you advise? Okay, I've got a few questions, Roland. First of all, you didn't mention that you had earned income. I presume you do because you say you live on a fixed income, but you're also contributing to your Vanguard Roth, which makes me think that you are actually working because you can only contribute to a Roth if you have earned income. Okay, next level of questions. If you have a lot of money that's sitting in a non-retirement account and you can pay the tax that is due, then you have no problem. Of course you can convert. The real question I have is, why convert when you might just be able to pull some of the money out? I mean, I'm worried that maybe we would be soaking up some of your cash at a time in your life where we'd want that. So I'm all for conversions. They're great, but you should not convert at the expense of maintaining liquidity. And also, we would really want to understand what your tax bracket looks like. Maybe you just convert a little bit at a time, or maybe you just pull the money out of the account, and that'll get you there as well. I hope that helps, and if you want to come back to us with more information, we're happy to do that as well. You are listening to the Jill on Money Show, and if you've got a financial question, we'd love to help you out. Go to JillOnMoney.com and click the Contact Us button. We've got a whole lot more fun around the corner. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You're back. It's the Jill on Money Show. This is the program that's trying to answer your financial questions or your big picture questions. Any question that deals with your life probably touches your money in some way. So if something is going on, we'd love to hear from you. Just go to our website, JillOnMoney.com, click the Contact Us button, and we'll get your note. If you'd like to join us live, don't forget to check the box so Mark can arrange to get you on the air with us. If not, don't worry, we read emails. In fact, we're going to do some emails this hour. If you do want to just keep it email only, try to give us enough information so we have the basis to make a recommendation or provide you with some counsel, because sometimes you leave some stuff out. I know you don't mean to, but sometimes you do. Anyway, everything is at JillOnMoney.com. Check out all the content that lives there, including our fabulous newsletter. Comes out every single Friday. Okay, right now, let's take an email. This is from Sam, who is asking about putting a house in a trust. And Sam writes, capturing my heart immediately, hello to my favorite money maven. I love that. It seems like I heard you imply on a previous show that putting a house into a trust might not be advisable. I'm thinking of establishing a trust, and I would appreciate your opinion on this specific aspect of funding a trust. The basic considerations for setting up a trust would make a great deep dive for a podcast if you haven't done so. Thanks for a response. I'm a painfully shy guy, so not going to come on the air. Okay, Sam. Listen, there's two different types of trusts, and it may be that you heard me talk a little bit about the house in a trust. I think we talked about it. We might have even mentioned this when we were talking to Ed Slott. Let's just do a trust in general. A trust is a legal document that allows you to put certain assets inside of that trust, and the assets that are inside of that trust will avoid the probate process upon death. So that's usually like a really nice feature of a trust. And the other piece is that, of course, because you're not going through probate, then the list of your assets is private, because probate is a public process, right? It's a court process. So here's the thing. There are two different kinds of trusts. One is called a revocable, which is changeable. One is irrevocable. You may have heard me talk a little bit about the irrevocable trust, which is often a question that is asked of us, where people are trying to say, well, I want to make sure that the quote unquote nursing home doesn't get my house. This is when I'm a little bit worried, because this is a case where I have heard some lawyers or estate planning professionals, I'm using air quotes for that, who will say, pay me to put together this trust so that you can put your house in it, and then that house is not considered an asset when you're applying for Medicaid, where you've basically impoverished yourself, so that you can qualify for long-term care from the government. That's the kind of trust that I'm worried about. First of all, putting a house into an irrevocable trust, or any asset into an irrevocable trust, will be tested by Medicaid. And there's a look back period. It could be 3 years, it could be 5 years, depends on the state where you live. The other thing is that once that money or that house goes into an irrevocable trust, okay, that means that you can't change it. Okay, remember, irrevocable, not changeable. So you can't change the terms of the trust, and you cannot change the beneficiaries. Okay, so what you may be thinking about is a revocable trust, where you can change things. As long as you're alive, you get to actually change it. Or if you did create a trust account, like an investment account that's labeled in the name of a trust, you can clearly make those changes whenever you want. You have protection of those assets during your lifetime. And, it does make it pretty easy upon death, because you do see that these assets will not be subject to probate. That can certainly eliminate some time and some expense, and it can also keep everything private, as I imagined. Now, the thing is, most people will have to go through probate anyway for some part of it. And the question is whether you really want to make sure that this house will transfer to somebody in a facile way. And if you think that that's important, that's great. If it's not really, it's not that big a deal. Like, as someone who's gone through probate and is kind of pain in the neck, but it's not terrible. And the cost of a trust is real. So in some respects, I think it's overdone as a planning tool. And if you are using it for a specific reason, that's great. But don't expect that everything is smooth sailing, because you have to make sure that all the assets are in the name of the trust. Otherwise, you're going to go through probate anyway. All right, let's do another email here. And again, our Friday focus today is estate planning. This message is from Joni. Joni writes, my husband and I are updating our wills. We have listed each other as our durable power of attorney, but we're having trouble coming up with a secondary person. Currently, our parents are listed, but they're aging. We each have small families, one sibling each. One is not good with money. Don't name that person. The other we just don't care for. Don't name that person. All right. We also have two nieces we find to be spoiled and entitled. All right. No family member will inherit from us. The vast majority of our estate, $5 million, is going to nonprofits. Our Roth IRAs, $400,000, are going to someone who will care for any pets we have at the time of our deaths. She lives out of state. I hate to burden her with this. We have friends we trust, but we're hesitant to burden them with such responsibilities. Question: can a professional, like an accountant, attorney, a financial advisor, act as one and be paid? A professional can actually be named as a durable power of attorney, but you might want to just ask your friends, because it's not that big a deal. It's actually pretty easy. And the power of attorney, that backup person would only be like if you and your husband are incapacitated at the exact same time and need a backup person. And, honestly, since you've already done your estate planning and the money is going to go to nonprofits and will pass by contract, and I don't think the durable power of attorney is not the major player in the estate process. But if you're asking me, like, who is the successor of the executor, that would be a different story. But you can also, ask people. They're usually happy to help, really. Okay, next up in our Friday focus on estate planning is from Matt, who says, I love your podcast and your radio show, which I listen to on YouTube. Hey, good job, Mark. Thanks to you and Mark for doing what you're doing. Okay, so Matt read a recent column that I wrote for Tribune about estate planning, and he was asking about irrevocable trusts. And he says, I'm not sure if I need one. I'm a renter. I live in an expensive city. I have beneficiaries and transfer on death on all of my accounts, my bank, my IRA, my brokerage. I'm 51. I'm single, no kids, no partner, no debt. Everything is paid for. I understand having a will, power of attorney, healthcare proxy, but do I need a trust? Besides real estate and bank brokerage accounts, what would I even put in there? For my personal possessions, paid off car, wouldn't it just go through probate? Probate in California is a little bit easier than other states, I'm told. Yeah, don't worry about it, Matt. You know, as we talked about at the top of the show, that trusts are used for usually to help with estate taxes or estate processes, or if you have kids and you have second marriages. And it's very good to kind of have a trust document that details all the things that you want to happen. But it sounds like you got it under control, so I wouldn't worry about it. If you've got a financial question, get thee to the JillOnMoney.com website. Just click that Contact Us button. We'll get a note. And if you want to join us on the air, check that box as well. Either way, we'd love to hear from you. The Jill on Money Show. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. We are here to try to help you make better financial decisions. We do that by having you get in touch with us at JillOnMoney.com. Let's take an email, and this one is from Mary. She writes, Hi, Jill. I thought you would appreciate not the recommendations from two financial planners, a quote fiduciary and a CFP. By the way, they're both, if one is a fiduciary and one is a CFP, then they're both fiduciaries. Okay. So my husband and I recently interviewed these two for an overall review of our financial situation, and we had planned to self-fund our long-term care needs. We're both 72. We're homeowners with income from pensions and Social Security, $130,000 a year. We will start taking our required minimum distributions next year, about $20,000. Wow, so they're going to have $150,000 a year in income. They've got $7,900 left on their mortgage. 2.75% interest will be paid off very shortly. They've got $65,000 in cash, $160,000 in Roths, $565,000 in IRAs, and we're slowly converting them to Roths. We don't have any other debt. We spend about $7,000 a month, leaving us savings of $2,500 a month. Mark, can you imagine 72 years old and you're still saving? Mary says the kids are grown, they support themselves, and she says our main concern is the potential risk that we are taking on with self-funding our long-term care needs should they arise. So this is what they did. They interviewed some financial planners. They wanted to see what they would recommend. And she writes, I am still in shock from this. The first one recommended a variable universal life policy for each of us that we would fund for $26,000 pending underwriting and physicals for a net benefit of $400,000 and net benefit increase in year 16. The second one recommended a FlexGuard series index variable annuity, which we would fund at $110,000 per account. We'd be protected up to 20% loss for 6 years using an S&P 500 average net return, blah, blah, blah. Just the names of these products raise red flags for me, nor could I understand them after inquiring twice about them. Needless to say, I was shocked by these recommendations, and I've decided to skip the financial planner plan and continue doing what we're doing. All right, Mary, I am also somewhat shocked. And maybe, you know what I would always love to do? I'd love to have an advisor come on the air and maybe point out what I'm missing. Because what I see is that you are saving money, right? And you've got this money in cash and you keep building up money, which I think you're probably using somewhat to move some of the money, to pay for the conversion, but you've got a bunch of money. You'll basically have $150,000 a year of income. Would it be possible that both of you would need full-time, full care at the exact same time, and you would blow through your money? I guess that is possible, but you do have $130,000 of income, or $150,000, which is a lot considering, your ages. You know what I would say? I wouldn't necessarily convert your retirement account. I don't know why they're doing that, because I'll tell you what I would do. I would just take my RMDs at this point. You don't need to convert. And once your mortgage is done and, and you'll probably have some more money, that you can put aside. I would just save the money, build up the cash. You've got your couple of years here. I would start a brokerage account right now with my 25 or $3,000 a month. And I would skip these products unless I'm really missing something. And by the way, everyone who's thinking about this, I know that we're all freaked out about long-term care. I get it. You hear these horror stories, but in reality, it is the rare case when people need hundreds and hundreds of thousands of dollars from their retirement accounts and their portfolios. And all these things have risk, right? It's not the norm. It's not the norm. So the norm is that you pay for care. It's not full-time care. You need some help. You guys are going to have the income to do it. So I think you keep doing what you're doing. And I like skipping the advice. Okay. WG. I'm not even going to say the name. WG, retirement help needed. Hi, Jill. Love your podcast. I want your take on our situation. Married, filing jointly, 64 and 62. Still working, $150,000 in W-2 income for another couple of years. Pension, $6,000 a month, and Social Security, $6,000 at age 70, meaning between the two of them, I think. We've got money in a 401k and a SEP IRA. So there's about $1.55 million in pre-tax money. There is some money and a Roth, 10 grand. Brokerage account, $1.5 million, mostly tech stocks like Tesla. House paid off, trust stocks completed. Need 10 grand a month for expenses, not concerned about having enough. Okay. However, I know I'm way overweighted in stocks, but I'm concerned about IRMA. Should I be doing Roth conversions, selling my tech positions, buying bonds in this low yield environment? It's not a low yield environment. It's a long yield. It's a high yield environment. I'm at a loss of what to do. Mark, I find it humorous that these people have over $3 million and the guy's freaked out about IRMA. Okay, once again, let's go through IRMA, guys. She's not your great aunt. She is someone who can really eat into your Medicare planning. So IRMA is Income-Related Monthly Adjustment Amount, IRMAA. And what this does is that when you have modified adjusted gross income over a certain amount, so $103,000 for an individual, $206,000 for a joint, then you have a surcharge to your Medicare. Now, if for some reason this freaks you out, which I don't know why it does, but I guess people are crazy, I'm going to give you the numbers. This is why I don't really think this is a big problem. I'm just sort of making fun of you. And so WG, don't worry. I do this in jest, but you're worth over $3 million. You didn't even tell us what the value of the house was. You're going to have plenty of income. You're not worried about anything. So if you look at your income, even at age 70, right, you're going to have $12,000 a month, right? So you're going to have about 150, but then you're going to have, let's say that you have even more. Let's say that because of your, you have investments and this, that, and the other thing. So let's pretend that you had married filing jointly $250,000 of income. The IRMA charge for that, meaning your surcharge, would be a whopping $1,000. That's what you're concerned about? Now, let's say you sold everything. You really wanted to do Roth conversions and you wanted to make sure that you could have all that money available to you. And the worst case scenario is that you'd have to pay $6,000 in a given year that you're doing Roth conversions. So what I would do is this. I would start thinking about doing some Roth conversions because you're going to get whacked. I would sell some of my tech stocks and get some cash, available for you guys, pay the tax that's due. And by the time you're 65, have this cleaned up a little bit. Maybe you're still going to have to pay some IRMA, but who cares? Why is everyone so freaked out about IRMA? I mean, we're talking literally, it is a maximum of $6,000 in a given year. And you've got millions. So if you're way overweighted in tax stocks and you are concerned about IRMA, I'm going to flip it and say, don't be so concerned about IRMA. If you want to take some of the money off the table in the tech sector, I feel good about that. If you're charitably inclined, that might be this might be a wonderful case where you take a low basis stock and you put it into a donor advised fund. That's something you should definitely consider. I'd love to get you on the air with us, truly. Because this is one of those situations where I really want people to understand that you're more concerned about something that is like, nonsense in the grand scheme of things than the thing that is the issue, which is the overweight in stocks. So I would love to have a follow-up conversation. During the break, go to JillOnMoney.com. That's our website, and bookmark it. I know you're going to want to return to that website whenever you have a question, and we'll always be there for you. The Jill on Money Show will be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's the Jill on Money Show, and we are here talking about the issues that are most important to you. Next up, an email from Emmanuel, who writes, "Hi, Jill. I'm a new listener and love the show. Yay! Thank you for listening. I'm 26 years old, and I'm just starting my career and my financial journey, so I appreciate all the great advice you give. I'm writing today concerned about my parents' financial situation and whether my dad can afford to retire within the next year. My dad came to the U.S. decades ago with nothing to his name and has worked hard to provide for our family. But the years of working hard as a blue-collar worker have taken their toll, and he wants to retire by the beginning of next year. My parents have always been frugal people living without much luxury, and they wish to continue to live a simple life once my dad retires. Here is a snapshot of the family situation. Dad's Roth IRA, $47,900. Dad's 401k pre-tax, $42,000. Dad's other 401k with a previous employer, just about $148,000. Mom's Roth, $46,000, and a high-yield savings account, $130,000, a checking account of $7,000. Okay, so here we go. Dad's projected Social Security benefits are $1,786 at his current age, $1,993 at age 67 and 7 months. That's his full retirement age. $2,500 at 70 years old. Okay. Oh, this is a bummer. Mom doesn't qualify for Social Security benefits because she's been a stay-at-home mom with no income for the past 17 years, taking care of my 5 younger siblings. Oh, my God. Current age is 10 to 17. But she would qualify for half of his, just to put that out there. So I don't know how old mom is. Let's see. Oh, mom's young. Okay. Let me keep going here. So their household expenses, $3,000 a month. No debt. House is worth $220,000. Dad is 66. Mom's only 49. All right. Dad has been the main source of income for the family. But ever since I've started working, I help cover some of the household expenses, insurance, groceries, etc. Being a large family and living in Texas, my parents' tax situation has been favorable throughout the years. My big concern, what do I do about medical insurance coverage for my mother and siblings once my dad retires? Right now, they have coverage through work. Dad is healthy. Mom has some ongoing minor medical issues that require medications. I'm thinking that shopping at the healthcare marketplace will be their best option. I'm not sure how they should account for healthcare expenses once my dad retires. Oh, this is so sweet, Mark. I want to cry. I love my family. I'll always be willing to help financially, but I need your help to assess their situation. Oof. Okay. So let's go through this, gang. This is one of the biggest issues about healthcare in retirement, especially when you have a disparity in age. So dad will qualify for Medicare, right? He's 66. So he will be able to qualify for Medicare. That's him. The question is the rest of the family. So here's what I think happens. I think you've got two choices. I think if you go into the marketplace, okay, if you go into the marketplace and dad is only making, I'm going to pretend he gets this $2,000, right? He's only making $2,000, okay? And so if he's only making $2,000 and that is the all of the income for the household, what'll happen is you'll sign up for some, let's call it a silver plan, and you will be getting tax credits because there is a cost, but they'll get money back. And I think they'll essentially be able to have free health care. I'm pretty sure that would work, because the only other way to think about it would be that mom and as a family, that mom with the kids would qualify for Medicaid. And I don't know which one is going to be the right way to go, but I think those are the two options. I'm pretty sure. And I think that because your father is older, although I'd love for him to be able to wait till age 70, they need the income. So he'll get $1993 in January. So he's going to retire, right? He'll claim his Social Security. He'll get this $2,000. Now to get the extra $3,000, they're going to have to pull some money from something. If you make below the poverty level for a family this size, then you would end up claiming through Medicaid. That's how they would get coverage. If it ends up that their income is 100% of the poverty level, then you would get a tax credit for going through the marketplace. So here's what I think you're going to need to do. You're going to have to walk your parents through this journey. And I know it is going to be hard, but I think that we look at, if it were just your father, it's easy peasy. It's like he gets a Social Security and he goes on to Medicare, fine. But for your mom, because she's younger, there is going to be a separate plan of coverage for your mother and your younger siblings. And so what they're really going to need, I know that you want to help financially, what they're really going to need is they're going to need your help in navigating this system. For everyone listening, you might think this is crazy because there's money, there's assets here. It's about the age difference and the cost of coverage. So I think that that's it. All right. The next question is from Jane about HSA accounts. And Jane writes, my husband and I work for the same employer and they offer an HSA. We want to start at one, but we wonder if we should have separate HSAs or a family HSA together or split one single and one family plan. We've got 2 daughters ending college. They're debt free. We want to focus on our retirement and healthcare future expenses. Our daughters would still be under our health plan until they age out. That would be age 26. My daughters embrace medical care, whereas my generation never saw a doctor, LOL. I think one does a family and one does an individual. And I bet that allows you to put a little bit more money away. So here's the thing that I don't know. Here's what I don't know, Jane. I don't know how much extra money you guys actually have. Because if you're planning, if you say like, you know what, we're both maxing our retirement accounts, we've got plenty of money, life is good, then yeah, I would try to put as much money as I possibly could in a health savings account because it's basically triple tax exempt, right? Because you get money that goes in and you get a deduction for that. It grows without taxation. When you pull it out to pay for healthcare expenses in the future, you're set. So what I want to know is how the rest of your financial life looks. Okay, that I really would be interested. Jill on Money will be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, the program that attempts to take the mystery out of your financial life. We do that by asking you to do a little bit of work. Just go to our website, jillonmoney.com, and click the Contact Us button. Complete the form, and if you'd like to join us live, check the box, and Mark does everything else because he is the best executive producer in the whole wide world. If you're shy, don't worry. We read emails on the air and answer those questions. Next up is an email from Ty, who says, I haven't heard any podcast on tax harvesting, and my financial planner wants me to start doing this. I'm confused. Okay, Ty, tax harvesting is amazing. We talk about it usually towards the end of the year, and it's usually just a way to think about managing your tax liability. This is obviously in a taxable brokerage account, not in a retirement account. Gang, remember, we don't pay taxes on the changes you make inside of a retirement account. But, the way that it would work is that you look at the account, I would say just an annual basis, because remember, we're trying to minimize the tax hit. And what this is allowing you to do is that you make sure that you sell something at a loss at the same time you sell something at a gain. And the gains and the losses wash against one another. You don't have to pay tax on that. However, if you have more losses than gains, which is kind of hard to find right around this time when markets have been trading higher, but if there are losses, you are allowed to take up to $3,000 of those excess losses against your ordinary income every year. Now, if you have one bad year and you had to pull the trigger and get out of something, those losses pile up. If it's more than $3,000, you get to carry it forward every single year. So there have been times where people have had big losses on something, and then they find themselves like, wow, I have company stock and there's huge gains, and you can use the gains against the losses. Hope that helps. Nancy writes, there's a question about selling a home. Hi, I live in the Bay Area and I owe $324,000 on my mortgage. I have a 2.5% 15-year loan with 13 years left. My husband and I are both 55 years old. We don't have a ton of liquid cash, but we have 2 401ks and a pension. Okay. No other debt other than the house, which is worth $1.5 million. And I'm curious if I should sell this house, pay off the mortgage, pay the realtor and the capital gains, and buy a new house for $1 million in cash and be mortgage free. Would like to know if this is a good idea. It kind of depends whether you like your house or not. I mean, a 2.5% 15-year loan is pretty amazing. So I think there's a couple of components of this. Number one, do you love this house? If you love this house, stick around. It's not a big deal. We'll figure it out with you. If it's too big a house and you just want to actually make your footprint smaller, then sure, this can make a lot of sense. I just think it really depends on your situation, how much you love the house, and can you really get into a house for $1 million? That's my other question, because often we'll talk to people and they'll say, yeah, I'm trying to downsize, and they can't. So sometimes the cost of moving and redecorating and doing something, it does add up. So the answer to your question is, should you? Is it a good idea? It could be, but I'd love to know more about what else is going on. Like the real qualitative, not the quantitative part. Okay. This is from Claire. Another house question. Dear Jill and Mark, I listen to you the first thing every morning, and I love your straightforward and get to the point style. Here it goes. Here's the question from Claire. How should we invest $240,000 from the proceeds of a vacation home sale as if we don't have it? Maybe T-bills and index funds? Okay, hold on. We've got multiple offers on an 11-acre lot with a pond that we bought for $350,000 back in 2012. Should we sell when my husband retires in 2 years to avoid capital gains or leave to our kids? I know we need to move a lot of money from 401k to Roth when my husband retires in 2 years, when he's 65 until he's 75. It looks too lopsided at the moment. What things are we not doing quite right? Okay. Now I have the numbers. I'm sorry. I should have started with this. So they are 63 and 61. They've got $600,000 in bank CDs and the proceeds of that house sale. They've got $1.7 million in a 401k traditional, $22,000 in a Roth, $37,000 in an HSA. Add the Social Security, $3,400 at husband's age 67, $2,000 spousal Social Security at 70. You know what you didn't tell me, Claire? You didn't tell me how much money you need to live on. All right, I'm going to do this as if I know the answer to it, but I don't. So how should you invest the money in cash? I would use a diversified portfolio. I mean, I would definitely look at T-bills, but I might use bonds. I might use index funds. I would make sure that I have enough money available in cash so that you could pay for the conversion when your husband does retire. He doesn't have to do it all at once, okay? The question about the money on the multiple offers on the lot with a pond, I would take the money and I would add that to the kitty and invest it, because I don't know how old your kids are, but they're going to get the money one way or another. And I'd like you to have that liquidity as you start really starting to, focus in on converting that $1.7 million into a Roth. That you're going to need to do that over time, and you're going to need the cash to do it. The Jill on Money Show will be right back. You're back. It's Jill on Money. And before we conclude the program, it's time to squeeze one more question in. This is from Diane. And Diane writes, I finally convinced my 27-year-old son, who works in government, so he'll never earn much there, to open a Roth IRA this year. My mother left him $300,000, which we put in a taxable Schwab brokerage account with treasuries and some exchange-traded funds. Can he take $6,500 from that account and contribute and transfer into his newly created Roth IRA? Diane, I have a lot of good news for you. First of all, the amount he can contribute is $7,000. That's the new limit for 2024. And so, yes, as long as he has earned income, of course, he can make a $7,000 contribution. But with this $300,000, maybe another idea would be to encourage him to use his government thrift savings plan and make a big contribution out of his salary. You usually can go up to 20% or 25%, and he can use the Roth version of a retirement plan at work. So I think that would be ideal. Not only would he use the Roth IRA, but also use the Roth version of the retirement plan at work. So I hope that helps. And of course, if he needs any help with the investing part, we're happy to assist as well. All right, well, that is it. That is our program. And man, it has gone by so fast. So we appreciate that. Remember, all of the things that we talk about every single weekend on this program, they are coming from you. So if you've got a particular issue and you want to get in touch with us, just go to the website, JillOnMoney.com, and click the Contact Us button. And while you're there, check out that subscription service, Jill on Money Live. We're doing a special Social Security webinar. It's coming up fast later this month. Our music is composed by Joel Goodman. Mark Talercio is our executive producer and king of all things web. We ask that you try to do something nice for someone else today, and maybe even every day. It's going to make that person feel good, and it's going to make you feel good. Change your work, change your wealth, change your life. Thanks for listening. We'll talk to you next week.